Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Rob McGregor, Managing Partner Investments at Coromandel Capital. Rob, it's really great to see you again. Thank you for coming on today. Looking forward to our conversation.
Yeah, likewise. Excited to dive into it.
So I think, to kind of kick off the conversation, I know you guys, kind of in the grand scheme of ABF, play a little bit more in the earlier side of the table. And so what does that landscape look like for, say, I'm an early stage lender, maybe I've gotten some venture money, I'm looking to add debt to, my capital stack. Kind of what does that landscape and environment look like today?
Yeah, really good question. There aren't a whole heck of a lot of people that we sort of bump into in the space, right? We don't bump into the Victory Parks or the Apollo, Ares, Fortress, Waterfall. We do not endeavor to compete against those folks. Candidly, they're probably smarter than me, and they have certainly done a better job of raising capital than I have. So what we've done is exactly kind of what you had mentioned. Someone who has raised, venture capital. We go through the process of educating them on, why debt would be a good sort of tool in the tool belt, especially as it relates to, preserving ownership in the business instead of getting more and more diluted. So I would say typically people will have raised anywhere between $5 to $20 million, in some cases a lot more. Really, that's kind of on the tails though. Like we just closed the deal where they'd raised like $700 million of equity. Very rare for that though. Generally speaking, maybe like a seed Series A. We'll come in, we'll provide $0 to $10 million of initial sort of funding to fund the balance sheet intensive parts of their business, and then scale that up to 20, 25, $30 million, if not more. Um, we're generally bumping into, folks who might be, prioritizing warrants or a bit heavier on warrants, or in some cases hybrid funds or traditional venture debt. But we actually find that traditional venture debt is actually a pretty good complement to us because they can fund all the exciting stuff at the opco, and we can fund the very boring stuff at an SPV level. And we're happy financing that stuff all day long.
Would you say this area of the market is healthy right now? If a few years ago, would you be bumping into more competition? Like, kind of, how would you kind of characterize this segment of the market? Healthy, not healthy?
Yeah, that's a really good question. So I would say there's a bit of a dichotomy. We have some companies who, for example, one client who's going to market and raising a bigger round a lot quicker than they had otherwise thought, they would because they've achieved sort of the KPIs that the venture backers of theirs have required in order to do the next raise. We've seen others where it's become, it's still pretty trying out there. Not become, as, just generally remains trying to raise the equity. But we've seen them respond pretty well, which is, making the tough cuts in staffing, pulling back on marketing, doing stuff to create that runway extension. So I would say it's somewhat of a split, businesses that are, performing really highly, they're hitting their MRR targets or managing risk incredibly well, and they have the Adam Newman-esque type sort of founders, they will be fine raising capital. And I think you're seeing a little bit more not irrational, more exuberance from venture as of late. I think they'll do just fine. But for those folks who are more blocking, tackling, don't have that sensationalized sort of front man, I think it will remain a little bit more trying.
Can you talk more about the evolution and optimization of capitalization with an early stage company?
Yeah. So we run into a lot of early stage companies. They may not have like a seasoned capital markets person. Their venture investors themselves may not even be all that seasoned when it comes to how to, you know, optimize and scale a specialty finance or fintech business. So they just think that they need to be on this equity treadmill of where you raise every 12 to 18 months the next round of equity, and you got to hit your venture related targets in order to do so and unlock that capital. But in my opinion, that is not the most prudent way to do that. I think that a lot of what we do is selling my education and explaining to folks that, you could find a lender that's solution oriented that can help provide, a solution that will scale you from those early days up to getting to the next raise or the raise beyond that, which creates a lot more leverage with you and your VCs because you can basically say to people, listen, we don't need your equity. It'd be nice to have your equity because we can grow a lot faster and we have a lot of opportunity, but we will take it under the right terms. So I think qualitatively, using debt, a credit facility for the asset heavy parts of the balance sheet is incredibly important tool in the tool belt for those operators. Another is just good old fashioned financial engineering. So most clients might be generating, 25, 30% IRR on the loans or leases or whatever the widget they've figured out, right?
Hmm.
We'll come in and say, listen, we'll provide a mid-teens facility to you. We'll finance 75 to 80% of your balance sheet on average. It ranges. We have advance rates less, we have advance rates higher, right? But on average, which means that when you multiply the advance rate by the cost of funds, we might be keeping half the revenue that they're generating, right, at the end of the day. But where the financial engineering comes into play in the optimization of their balance sheet is we're financing 80% of the cost, right? So they keep half the revenue, but they're only putting up 20% of the cost, which means they're getting a massive levered ROE, which also not only does it provide the scalability of starting from 5 million up to 30 million or so, but they're getting a nice return on that and they're showing their VCs that they have alternative forms of financing. Another thing that we try and educate people on too, which we don't ourselves engage in, is the benefits of forward flows, right? Much like a senior secured credit facility from us, you know, we don't want to say that people shouldn't do forward flows just because it would be self-serving and help us grow our facility. We actually view that as a really good way for someone to optimize their business because less so these days, but in some cases, you could sell loans beyond, par, so clip 2, 3 points up front. You can then use those premiums, the 3 points I mentioned, to plow it into the haircut capital of a credit facility, which allows you to show your VCs that you're able to, sort of fund the balance sheet intensive parts of your business without raising venture money. So these are a lot of the things that we, just pull the cord, right? That like I say a lot to folks to educate them on better ways to kind of grow their business. And in doing so, I think it sort of allows folks to perceive you as more of a partner instead of a lot of what exists in the industry more generally, especially coming from banking, a lot of zero sum mentalities, obfuscation, stuff like that. So what we realize is that people need partners this early on. Things are going to go, bad and at some point in varying degrees of magnitude. And you need someone that's going to be solution oriented, that's going to provide you with advice on how to navigate these things, as well as scale your business in a prudent fashion, taking less dilution. Let me pause there.
You've been around the space for a while. How would you say the education is, say, today versus 5, 10 years ago? I mean, is the founder early stage company today a little bit more knowledgeable and better suited versus, say, 5 or 10 years ago? It felt like there was a lot of technology players trying to remake financial, whether it be banking or loan systems or whatever it might be. Is that still the case today, or has been a little bit of an evolution where there's a little more education from your borrowers today than, say, 10 or 15 years ago with founders that might be coming into the market?
I would say more the former. I think the former in that case, right? Like, I think folks are more educated on a relative basis. So, at my core, I'm a boring specialty finance analyst. That's what I did at Moody's and Credit Suisse. I've just been in this sort of ecosystem for a while, and I would definitely agree with your sentiment that, especially when you look at the early days of like a Prosper or a Lending Club
Yeah.
and the peer-to-peer lending, right? You put a loan for Rob McGregor up on the portal, and someone does the math on whether Rob McGregor is good risk or not, right? And they're good at marketing. And I think they found their core competencies kind of coming back to that marketing. But I also think in a lot of respects, they've done an awesome job of, and they being these fintechs and specialty finance companies, of understanding risk better. So I think people are focused on not just having the product market fit, but actually understanding the true unit economics of the collateral that they're originating and how that plays into modeling out and the viability of their business model more generally. And but we do see some stuff every once in a while where folks, you start actually, going through the unit economics waterfall and you realize the asset itself is underwater. And our own personal take is being the potential owner of those assets, that those aren't deals that we could do. And we try and encourage folks to find ancillary forms of revenue or to press their, in some cases, I gave one client this feedback, you can't save the world unless you're around, right?
Yeah.
So they had product market fit, but they weren't maximizing their unit economics enough, meaning they weren't pressing pricing, they weren't pricing risk adjusted what that cohort of risk should look like. So they've actually changed and adjusted to more of a risk-based pricing mechanism. And I would say that's more representative of people nowadays, is that you would have a lot more of those conversations on how you need to maximize pricing, whereas a lot of people now are coming in already doing that.
Before we continue, tell us a little bit more about, Coromandel. What do you guys look like today? Are is there kind of an evolution of kind of where you guys fit in the market, the mandate, the focus? Tell us a little bit more about the firm.
Yes, we are a product of pandemics, rate hikes, bank crises, you name it. So all we've ever known is sort of chaos. Luckily, we're boring senior secured lenders, so that's a relative statement, I guess. So myself and my two co-founders came together in March of 2019. We started putting dollars out the door in January 2020. We were lucky enough to find an awesome group to align with who capitalized us with some money. They helped us scale through COVID. Luckily, we kind of closed that deal before COVID even became a thing. So better to be, I guess, lucky than smart in some respects, or some combination of those two things. So we were very fortunate in that respect, but unfortunate in the fact that you have this you know grand aspiration of, you built this business plan, you're going to go out, you're going to market a larger fund. It's going to be a traditional GP LP fund, commingled. Everyone's going to give you a bunch of money, right? You're going to do great stuff, and then enter a pandemic. So we were kind of sidelined, like a lot of people, for a couple of years where we really couldn't get in front of people, right? Even though we were still going to see our borrowers, which before we put dollars at the door, which was kind of crazy because you'd be standing 10 feet away from people doing walks around offices that are no longer really occupied by people, just like
Very
desks and
strange.
photos of family and stuff, right?
Yeah.
But nonetheless, you want to make sure the traditional blocking and tackling, that there are walls and there's roofs and there's really an office, and spend time with the people, just because candidly it's a little more difficult to lie to someone when you're in front of them. Not that people lie to you, but people.
100%. It's so much easier to see that level of, the unsaid
Yes,
body language in the room, and you get that better sense versus through a screen. It's very, very hard.
100%. At that point, I was a little bit younger as I navigate like a head cold here. This was 7 years ago, so I had an immune system that wasn't eroded by two young kids from daycare. But so I digress. Going back to that, after a couple years, we managed to extend, start doing road shows, get out there, shake hands, kiss babies, meet new investors, that sort of stuff, which was awesome. Pick up where we left off with our business plan. And then more recently, we had launched that traditional commingled fund, which was pretty good. And we operate those vehicles, and we just do a lot of the same. So one thing that resonated with me, we had met the CIO of a university and said, today is not the day, but we invest in emerging managers. 5 years from now, we will take a serious look at you. And but what we want to see is no mandate strain. That what you've told me today, you will have done in 5 years. You can point to that being thematically consistent, right? So that's a lot of what we try and do as boring lenders, just executing on that same strategy, reminding people that what we told them we were going to do, we went out and did that. Just because that's a lot of what investors want from a certainty perspective. And we know we need that certainty in order to go to market. and earn the trust of our borrowers in order to, for them to rely upon us being, capital they can use to grow their businesses, which is something that we take incredibly seriously and been very fortunate that folks have entrusted us with that responsibility.
That's like a perfect segue to my next question, which is, what are some of the common pitfalls that, early stage companies, what are some of those common pitfalls that they make? And then, kind of a secondary question to that, has the you mentioned there's a little bit of exuberance coming back to venture, but it wasn't the
Mhm.
days of like 21 and where it was just chaos everywhere and there couldn't be more money flooding the market. It feels like venture's kind of tamped down there, grow at any cost possible. Has that allowed for a bit more healthy dynamic for the founder, even for you guys within the market dealing, because you're in a lot of ways dealing with venture backed or even venture debt, and there's kind of a complement to that puzzle.
Yeah. So I think there are a couple questions in there. In terms of are we seeing like I'll answer the first one. In terms of, common pitfalls, I would say people weren't optimizing for unit economics. One big pitfall, actually, let me trade those pitfalls, is that people who come off raising a lot of money always think they will be able to raise a lot of money, right?
Yeah.
Which I get it. It's only human to think that, like you're coming off a big win and you want to continue to ride that wave and you think it's always going to be like that because you just went over a massive hurdle, right? But I think folks, a big pitfall is, realizing as entrepreneurs, there are a lot more lows than highs, and you need to constantly remind yourself of those lows. And when you raise that bunch of money, don't immediately try and go spend it, right? Try and craft a very incredibly thoughtful projection model where you are able to achieve 18 months of runway or something. In reality, you understand that there's going to be variability, there's going to be hiccups, stuff that's going to consume that money, that's going to truncate that runway. But when you're going and having conversations with venture, you want to make sure you're doing it from a position of leverage, because a tale is all this time that we see is folks try to raise money when they need it, not when they don't need it, right? Which creates insane amounts of, leverage for the VCs and even some of the lenders, candidly, too, right?
Yeah.
Like, which puts the founders, in my opinion, in a really precarious position. So you want to be able to negotiate from strength. And I think having sufficiency of liquidity and as optimized of a business as you can is the best way to prepare you for that. So that I would say that's probably one of the biggest pitfalls we see. And then another, just to kind of touch on one more, would
Hmm.
be, you know, people growing too fast. So given that a lot of these folks are intermediating credit, um, they see top of funnel growing and they want to capitalize on that because they say, okay, we got debt here, we're making good yields on the paper. Let's, hoover up all this volume and we'll generate more net interest margin or excess spread, however you want to refer to it. And we'll be able to, reduce our burn because we have operating leverage in the system. Folks don't realize a couple things that you want to show lenders, lenders of the future mainly too, as well as your existing lenders, that you're able to prudently sort of consume volume and translate that into good performance, as well as the fact that you don't want to run through all the capital you've raised, right? So you want to show that you're a prudent sort of allocator of that capital and you're actually overlaying risk correctly, risk paradigms correctly to promote good financial performance. So I would say it's another pitfall as well.
And it's always easy to give the money out and to scale, like, oh, we're giving money out, giving money out. But that performance part and, the economy these days can change on a dime. And people have excess money to pay your loan within their bills. And then when the spigot kind of turns off a little bit, your loan could be put to the side because they'll pay their mortgage, their car, and their daycare first. And so, it's always interesting to see how quickly someone scales, but it's always easy to give money. It's not always necessarily easy to collect it back.
Yeah. Yeah, we say that exact same thing to folks a lot. But you end up being kind of like the downer at the party, right? It's like we got all this money, we got all this volume coming in, we're the best, and now you're telling us, hey, don't like blow through all that because you might not get like a lot of the money back. Just slow down
Yeah.
a little bit. And a bit of a damper, but that's our role in some respects. And sometimes it doesn't resonate with folks, but I think in a lot of respects it resonates with people. And I think those are good fits for us, for folks that, realize that at their core, they're risk managers. That's what they're doing, and they need to be thoughtful of that despite, the equity tensions that kind of emerge to say grow, grow, grow.
What about the venture dynamic? Has it kind of leveled off a little bit to say like that more normalized area from a few years ago where it just felt like tons of money flooding the market, everyone's got to grow at this like crazy rate. It feels like it's gotten to at least a more equal balance to like that more natural where place where it should be.
I would agree with that. We're hearing portfolio companies talk a lot more about like, contribution margins and runway and things like that instead of, 4 or 5 years ago. Folks were just like, we got 12 months of runway. And I'm like, oh God, like you only have 12 months of runway. You just closed the round. Like, but it's like, yeah, but we're growing well. Like we're hitting our KPIs. And it's like, but you're not setting yourself up for success. Sorry to be the cynical, skeptical, lender here. Like the equity markets may not always be favorable. So, in some respects, we've, I think, been proven right, right? But like, you don't want to say, I told you so to people. But I would definitely say there's been a lot more pragmatic, long-term orientation, amongst operators and their VCs in terms of how they're thinking about growing and the health of that growth.
Fintech and specialty finance have done a great job to kind of pick the slack that banks have in some ways left behind or at least exited post GFC in this new regulatory world. Are there any particular industries or sectors that you think are continue to be underserved by traditional, and you're seeing kind of specialty finance and fintech kind of continue to grow into?
Man, so we're boring lenders, right? So I still read stuff like senior loan officer surveys, and it still looks as though risk is pretty off with banks. I think banks are excited at the prospect of lending to someone like me, who then lends to a small business lender or a consumer lender or someone like that. I would say broadly ranks banks are still pretty risk off. So a lot of these fintechs are, the true intermediaries of credit. I would say small businesses are still incredibly underserved. One thing that we unfortunately see from time to time, and we don't play in this space at all, is the usage of merchant cash advances, and then you see this phenomenon of loan, these financing stack up on top of one another, but we don't play in that space just because I'm a boring regulatory nerd, and you look at the commercial financing legislation on state levels, and everyone's moving towards these more TILA type disclosures. And I think with education, a lot of these small businesses will finally realize what they've signed up for, which is they candidly don't realize what they've signed up for in a lot of respects. And some of these MCAs are not sort of operating within the confines of what they have kind of sold the small business on, right? They can be really punitive on a business. So I still think there is a massive opportunity to lend to small businesses because unless like you have a certain amount of bank balances where they're benefiting from the reserve requirement trade where you might have a couple $1 million that you deposit with them or have flowing through their system, and then they basically lend it out at infinity because reserve requirements are so low right now, right? If you don't have that, if you aren't generating free cash flow positively, then a lot of banks will just look at you and say, this isn't a fit. Even if someone might have $20 million of cash in their bank and they're only burning a couple 100,000 per month, right? Like they're not interested in doing the math on, okay, how much runway do you have left? So I still think a lot of businesses will be underserved. I think consumers are pretty underserved too. You've seen credit unions step in some respects and help out, right? But banks don't really care about, giving someone a personal loan. So I think that that is very firmly will be owned by the fintechs and specialty finance companies of the world, especially when you look at like the one mains, right? Like who have spent
Yeah.
decades cultivating relationships with brick and mortar locations and built that trust with these consumers. They basically view them as a bank instead of an actual bank who's hitting people with NSFs and all sorts of stuff, right? So I tend to think that you're going to continue to see this proliferation of these non-traditional credit intermediaries with fintechs and specialty finance companies in consumers, in small businesses, and that'll continue to sort of grow over time.
I feel like with on the consumer side, it feels like it's if you have good credit, the problem's been solved. You can get, credit at the checkout. You can get a personal loan from any one of the fintechs. Like good credit folks have had their issues solved with getting loans. I feel like in consumer, it's more like good credit versus bad credit. But on the business side, it still feels like there hasn't been like a ton of progress, and no one's really cracked like, all right, we've gotten it with small businesses. We know how to lend to them. We know how to do it profitably, fastly, seamlessly. It still feels like it's fits and starts. You hear about like a good small business lender, and then they kind of fade a little bit, and it feels like that really hasn't fully been cracked yet.
I think that's a really fair comment because I feel like if I had to choose versus consumer small business, what's more underserved, I would say, from a fair option, perspective, for lack of a better term, that's not remotely eloquent, but nonetheless, what I used. You see banks willing to price someone at like, call it like, prime plus or minus spread based on deposit relationships and stuff like that. And then there's almost this massive void until you get to like MCAs, and you have some folks kind of in between there, like the Ondex, which was it now like as of a few years ago part of Enova, and like
Yeah.
some other players like you'd Cabbage and folks like that. But no one who's really operating at like call it like 25, 30 with like massive scale, in my opinion. Right. And maybe even inside that, like it feels like there definitely is room for someone to be providing like a high teens, low 20s type product to a small business at scale and securitizing. You see a lot more MCA though, which I get they're serving a need, much like payday and title and stuff like that, but it's just, unfortunate, I guess.
When thinking about kind of the growth of private credit, a lot of these asset classes that we've been talking about, especially finance, fintech, how educated would you say the LP is on some of these opportunities, say from a few years ago to today? Because I feel like the menu of options for LPs has continued to grow. It seems like they've put money to work in certain markets. Direct lending is certainly well served. ABF is growing. Private credit certainly has expanded beyond just direct lending. How educated would you say the LP is today on these various options: fintech, specialty finance, NAV finance, fund finance?
Yeah, I would say today they're definitely more educated, especially coming armed to the conversation for co-invest. So sometimes that's how you end up getting to know LPs, right? Just like through a co-invest, and then they might put an LP check into the fund or something like that. That's how some people go to market. Um, and in those conversations, just to dimension your question, I would say that some people truly are understanding the landscape. I'm not sure they're at the level where they're running their own sort of bespoke cash flow models, right? I think at that point they're still leaning on managers,
Hmm.
but I think they understand the idea of like cash flow models, default timing curves, prepayment speeds, understanding different agency methodologies and what break-even multiples look like. Like, and the fact that these things exist, maybe not proficiently sort of understanding what break-even multiple might correspond to a certain asset class or something, but knowing that these things exist and consuming that information. So I would definitely, I'm just trying to contextualize the question, the answer to the question. And I think
Hmm.
LPs are definitely smarter than maybe 5, 10 years ago, where this is all fairly, you know, sort of uncharted territory for them, I think. And I think a lot are doing direct deals too.
And that piece, just kind of think of a follow up there. Um, is that how much healthier is that for the market if they're co-investing more, they're getting involved directly more? Is that kind of a trend that you see continuing in the next few years as kind of this area of private credit just seems to continuously grow and grow and grow? I mean, the likes of Apollo have said it's got 20 trillion, of a potential market cap to it.
I hope they're right, by the way. That would mean that we could manage a
I hope we're
trillion of
all
that.
right. Yeah, yeah. So that I can continue to talk about it too.
Yeah, yeah. So We do hear the word co-invest a lot more. I think that when they talk with their LPs, it's a function of trying to show that they're providing value and that you're just not stacking fees on top of each other, right? And realizing that they get more margin expansion by doing direct deals and co-invests. We've been super fortunate with some folks that we've aligned with that do both, right? Um, I would imagine that that trend will continue, that as businesses grow, they will try to do deals directly. Um, but I think it's healthy that folks recognize that like these are some industries like take years and years and years to cultivate knowledge. So after reading a couple pre-sale reports and one rating agency methodology, you're probably not prepared to do like, a you know $25 million deal or something, right? I would say that from an LP perspective, it'd be incredibly healthy to make an investment into a fund, do some co-invest, learn along the way, continue to do co-invest, look under the hood of direct deals, understand how managers think about these things, and then over time build out your own function once you've cultivated the requisite knowledge that will ensure you don't get burned, right? Just because like we do have conversations and there's sometimes like people overlooking regulatory risks or not modeling things correctly, and you're kind of like, shoot, like, that isn't right, and you just hope that when you're not talking to them, they're not making those sorts of mistakes and getting hurt, right? So I would say it'd be healthy for LPs to sort of continue down the co-invest side and investing with managers until they sort of hit that critical mass of knowledge where they know like they're a true subject matter expert or something.
And how do you think about, kind of the scalability of some of the niche lending strategies out there with, without kind of hurting performance and trying to push for scale?
That's a great question. That's a conversation that we have a lot with LPs, right? Is how big is the strategy? We think that it's about a $500 million strategy, at least for what we're doing, just like
Hmm.
senior secured, and for what we're seeing through our pipeline. So we think personally, like not personally, corporately for Coromandel, that like we could put $500 million to work and not compromise on LTVs, not compromise on pricing, not widen our buy box, sort of business as usual, and more intent on continuing to execute in that manner. Um, I think at a certain point, though, a lot of folks start to contemplate, okay, do we launch a continuation fund? Meaning in this context, like, do we start doing like lower yielding deals at lower LTVs that you could access insurance capital and maybe do like a rated feeder or
Hmm.
something into it, and you start to kind of mandate stray. But as an emerging manager, we're laser focused on not mandate straying, just because we want to have some of those conversations we had 5 years ago with people to be able to look back and say, listen, we said we are going to do that, we did that, we continue to do that, we'll be doing this in 5 years again.
And when it comes to, obviously, technology has become, um, a must for pretty much everyone in every business. How do you think about the role of technology for either Coromandel when you think about sourcing, underwriting, monitoring? Kind of how do you think about using it, whether it be AI or other technologies, as we become a more technologically savvy, universe, especially in private credit? How do you guys think about the technology angle?
Yeah, so that's a great question. Not to say that's a great question again, but these are good questions. So I think a lot about this, and again, I'm a boring specialty finance analyst, so like my extent of like technology is like using Perplexity, right? Like the deep research function, which I think is awesome to actually generate like SWOT analyses, addressable market analyses, understanding who players are, getting up to speed on a space really quickly. But I think a lot about, and we're actually in the market to hire someone that would sort of spearhead this initiative within our firm, integrating AI and ML and LLMs and SLMs into our business, building these, data lake repositories where we can sort of put tons of data into it, let the technology do analytics to provide lift on our existing sort of frameworks, right? Because I don't think we're really doing a good enough job of that. And I suspect I'm probably not the only one in the space that isn't doing a good enough job of doing that. But I think we're recognizing that we have these voids and we want to find the resources necessary to plug them to help us actually scale and be competitive. Because I think, to your point, if you're not adopting these sorts of frameworks, you're going to not get to decisions as quickly, or you are going to fall behind relative to competitors who do adopt these things, and maybe you'll miss something from a risk perspective that otherwise, a traditional regression might not have sort of made evident, right? So I think we want to continue to evolve as these tools present themselves. That said, we have done some integrations using things like Plaid and things of that nature, right? That have streamlined some diligences and some other technology providers that we've aligned with to create more efficacy and authenticity as it relates to collateral or financing. We'll do that stuff all day long, but as it relates to kind of the sexier, like, AI stuff, and you see all these GPUs flying off the shelves, like we're trying to be thoughtful of how we can prudently integrate these things into our business, as well as in some case finance them. But on the latter, it's been pretty frothy in terms of data centers and that type, the equipments that sort of, build those out. So we haven't
Hmm.
actually hit any bids quite yet with them. And I'm starting to feel like in some respects, it's almost like I'm sure you remember like the e-commerce aggregator sort of phenomenon where like people were dying to like lend money to these folks. And we
Yeah.
penciled things out and we couldn't make the math. And we kind of like scratched our head and we're like, maybe other people are better at this than we are. Like we just can't like, we're not hitting bids. And then all of a sudden the bottom fell out on some of them. You're like, oh, well, okay, there it is. So we're trying to be thoughtful about not only integrating, but being disciplined about where we're deploying capital into some of these things too.
Yeah, as kind of a follow up to that, being that you guys are playing in, conceivably the earlier stage of the market and lower check sizes compared to like the hundreds of millions and even
Yeah.
billions of dollars, is there a worry that some of this market could be automated by AI or in the future where some of this relationship and some of what you guys are doing because it's in the earlier part of the stack with smaller check sizes that AI can replace what Coromandel does in the market?
Man, I don't know the answer to that question. I would welcome that opportunity because I feel like embracing those tools, we could, do a lot more with a lot less from like a full-time employee
Yeah,
perspective.
yeah.
It's possible, right? I'm not sure it's probable just because I think that there is a lot of relationship building, and I'm trying to quickly search for another term in my head beyond hand holding, but in some respects, hand holding that, goes on, right? Where
Hmm.
you're the first institutional check for someone. You need to explain the fact that why you exist relative to venture debt, how you can coexist with venture debt, how they can use equity more efficiently in addition to the debt you're providing them. So I don't know how that sales cycle could be disrupted, and the
And
education associated with it.
and at
I
the end of
think
the
that,
day, some of this is a people business. I mean, you said
yeah,
it earlier. You can get a feel for someone by standing with them, walking around their offices, being present with them. Like if you just, replace that with here are the numbers, here are the algorithms, and then like here's the all right, here's your check for 20 million. And then it's
oh
like,
man,
all right, well, there's no feel here. Someone could fudge numbers like it's more of a theoretical question, obviously,
yeah.
but I'm curious if like someone in your position who started a fund, you're at, the smaller end of the market feels like someone would try that sooner than a $2 billion deal or something.
Yeah, I think it's totally fair to ask. I mean, you look at like the Pagayas of the world who've, sort of they'll package up other platforms, large platforms, collateral and securitize it. I think it would be egotistical for me to pretend as though like we couldn't be disrupted. And when I say we, I mean like the folks that we sort of play with in this ecosystem, because
Hmm.
there are a lot of people and a lot of good actors as well too. So it's not just Coromandel sort of doing, what I think is a good day's work. But I think it would be naive to think that someone couldn't displace us at some point. And I think that's why it's super important for us to try and, harness a lot of these new innovations in order to prevent from being disrupted. Um, but maybe some of these will help us. I'll get to see a little bit more of my family. I don't know how my wife and kids will feel about it, but hopefully they'll be excited.
One final question before we get to
Yeah.
a few fun questions and then out the door. Kind of what do you see as speaking of the near and somewhat near future as kind of the most compelling opportunities for Coromandel over the next few years, and how do you position for some of that now?
So spent a lot of time reading research, trying to understand demographics and not to use, I'm a hockey player, so I grew up playing hockey and lacrosse, but hockey in this particular example, where the puck is going, right? Wayne Gretzky. So we try and think about where the puck is going. You look at demographics in the US and the fact that the most people can't, support a $400 or more unexpected expense. You look at the fact that, younger generations are getting frozen out of housing markets, and you've seen the accumulation of housing at an institutional scale, in order to rent out to some of these folks. So I continue to think that, people who sort of position their businesses around, addressing those needs, whether it's something like property management to single family rentals, or, you know, owning properties and or providing financing to owners of those properties as additional credit, whether it's like a second lien behind like a first lien, or providing an advance that accelerates the realization of that rent payment. So that way someone can kind of, an operator can bootstrap can bootstrap their portfolio instead of relying upon institutional capital and just bank debt. So I think that housing, which is a massive market in and of itself, will remain, especially with rates coming down, right? And hopefully there's certain some adverse, tailwind or headwind, sorry, presenting themselves. But I think more generally positioning products positioned around, supporting the, single family rental space will continue to do pretty well. Um, I would say that that would make sense for people to focus on. I think another thing we spend a lot of time thinking about where we deploy capital is priority of payment, right? So you touched on it earlier with housing, with auto. It'll be very interesting to see in terms of like the next downturn. I have this TransUnion study emblazoned in my mind. Whenever I close my eyes, I can see the graph, but for the life of me, I can't find the presentation anymore, where they used delinquencies as a proxy for priority of payment. And you saw, residential mortgage delinquencies kind of like spike, and people protected auto shifted to the top because you need to go to the grocery store. You needed to take your kid to soccer practice. You needed to drive to that job interview because you lost your job, but it took forever to get kicked out of your home, especially in a judicial foreclosure state. Now I'm very interested to see with auto, okay, from this work from home, right, that we've gotten very used to, even though you're
Mm-hmm.
looking at more of a hybrid mentality now with a few days in the office and some people are full back to office. In the next downturn, does that hurt the priority of payment as it relates to auto? I think it probably does in some respect. I don't know if it, moves them down a rung or moves something else up. But I think that going back to what we were talking about, being a tried and true relationship, or does it touch on like a one main or someone? And I have no relationship with them. I just think they've done a good job um, of earning the trust of a consumer. That type of brand will persevere well because you're not commoditizing your product, and you're building a relationship with someone that, like most Americans, generally don't have a liquidity valve at some point, and they're going to need you. And if you're there for them, I think positioning yourself in that respect will also put you higher up in the priority of payments and portend good things for you. So, not to give too answers to your question, but those are some thoughts, that things I think about.
So some fun questions as we look to wrap up here. Favorite sports teams and or hobby?
Man, I am unfortunately a Giants fan, so not the best start to the season last night. So New York sports fan, living in Rhode Island, so it doesn't make that much easier either. A lot of New England sports fans, even though the Pats didn't have a great start either. And hobbies, I would say golf. I know that's kind of cliche, right? But like, I'm
What's
a
the handicap?
25 handicap, and any
What
excuse
you
to
said,
get
5?
25, 25.
Oh, all right. I was
Yeah.
about to say 5. Wow, I'm talking
No,
to a really
no.
good
A lot
golfer
of,
here.
as my wife can attest to, I am a work in progress on many fronts. But 25 handicap, I'm hoping to get that down. But it's honestly a good excuse to, get away from the monitors, because I think
Yep,
that, I love what I do, and I spend a lot more time working than, maybe I probably should. But it's tough not to when you sort of control your own destiny and you love what you do. So golf is
agreed.
kind of my outlet nowadays. I used to play hockey. I actually got, someone laid me out in a men's league last year, and you're not supposed to hit in men's league. With two kids, I start thinking about the implications of concussions and stuff, right? And,
So golf's definitely the safer way to go.
should be less contact in golf, I think.
Tell us one surprising thing about yourself.
One surprising thing about myself. Um, I didn't go to Disney World until I was like 31. Uh, I don't know if that's really novel or not. My family's from New Zealand originally. That's where the name Coromandel comes from.
Interesting.
So I went through my whole childhood and even, even after that, like I still have friends who go to Disney every year, right, with their kids. Um, and, everyone would talk about Disney World or Disneyland. And I'd ask my parents, like, why aren't we doing that? And it's like, oh, we're, getting shipped to New Zealand every summer. So it was awesome doing that, but it would have been nice to fit in some conversations, and understand what the American childhood was like. But I was very
Well,
fortunate on
that's certainly
home.
one of the more unique answers I've gotten on that question so far. So,
Yeah.
one book you'd recommend reading?
So it's not a new book, but I would recommend reading it. It resonated with me on not only like a finance perspective, but just like on a personal, emotional basis too. Red Notice. I don't know if you've read it or not, by Bill Browder.
I've
Um,
heard of it. I haven't read it yet, but I think one
awesome,
other
awesome
guest
read.
did bring that up as well.
Basically, like, he's a fund manager and he cut his teeth on basically evaluating frontier markets after the fall of the USSR. He saw some shady stuff happen. His lawyer, this guy Sergei Magnitsky, actually ended up sort of becoming a sort of casualty, collateral damage, with some encounters with, the Russian government, and the ultimately that manifested in the Magnitsky Act, which came out, I can't remember, like 15 years ago or something, right, with the U.S. Against Russia, and it was just awesome to see this incredibly smart, talented guy navigate his early career, and then when a good friend and colleague of his sort of ended up dying because he was, basically a prisoner, right, prisoner of war effectively, not in the traditional sense of war. Um, but just seeing him navigate that and making it his life's mission to fight against those sorts of things. So this guy could have continued to go on to be a fund manager, make a lot of money, and not put himself in the crosshairs, but he nonetheless made it his life's mission. So I think it resonates with me not only because like I'm a finance nerd and I appreciate some of that detail, but I think sometimes we lose sight of the fact that we get enveloped in our work and forget about the important things like friendships and family and pursuing the good at the end of the day. And I think that was a good reminder for me to always sort of keep that in mind.
I mean, you clearly love what you do, but what's the most exciting part of your job?
I would say getting to interact with all these entrepreneurs in a lot of respects that, are creating new, I wouldn't say anyone's reinventing intermediating credit, but you look at some of the cool spins on products and the ways they're formulating things, and in some cases, like the lives they, left in order to do that. And you're kind of like, as an entrepreneur, like we did that, and the lows are incredibly common as compared to the highs. And the fact that I could be so intellectually stimulated and learn so much from all these people that are doing these differentiated things, and candidly, like are incredibly smart people, right? Like it's humbling and it's interesting to learn about these models. So I truly get excited to jump on the phone with these people, and a lot of cases people say, "I'm sorry, for not sorry, but like, appreciate you taking the time." And it's like, I appreciate you taking the time. Like I get to do something that I love doing.
Yeah.
So, thank you for letting me do this.
And then one final question, one prediction for the next 12 months that I can hold you to.
Oh shit. Actually, I'm pretty proud of myself. That's the first time I slipped up on cursing on this call. So prediction. I can't say something generically that rates will decrease, because I think that's
I think
that's a
that's
pretty
coming.
high probability outcome. Um, I think that economically you'll see less duress than things have been sensationalized. I think that nowadays we get fed a lot of information incredibly quickly, and whatever the saying is, if it bleeds, it reads type stuff. People consume stuff, and all these very volatile sort of reads off of information. I think generally speaking, things will be less volatile than most expect. Even in terms of people, I've been candidly waiting for the consumer to break, and they've been incredibly resilient, and performance in unsecured collateral has been pretty good. So I think that things will be more boring than people anticipate. Is that even a fair answer to the question?
No, I think that's a fair answer.
Okay.
That's the answer that you're giving me. So I think it's fair. Well, Rob, I really appreciate you taking the time. It's great to see you again. Continued success to you and the team, and your growing family as well. So thanks so much.
Awesome. Thank you, Todd. Appreciate you, man.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.